The 2008 stock market crash was a significant financial crisis that had a global impact. It was triggered by the collapse of the housing market in the United States and the resulting credit crunch. The events that led up to the crash and the effects that it had on economies around the world are complex and far-reaching. The roots of the 2008 stock market crash can be traced back to the early 2000s when the U.S. housing market was booming. During this time, many financial institutions began to offer subprime mortgages to borrowers with poor credit histories. These loans had a high risk of default, but banks and other financial institutions were able to securitize them and sell them to investors as mortgage-backed securities. As the housing market continued to grow, banks and other financial institutions increased the amount of subprime loans they were offering, and investors became increasingly eager to purchase mortgage-backed securities. However, in 2006, the housing market began to show signs of slowing down. The prices of homes started to fall, and many borrowers with subprime loans began to default on their loans. This led to a wave of foreclosures, and many of the mortgage-backed securities that had been sold to investors were revealed to be worth much less than their original value. This created a huge wave of losses for banks and other financial institutions, which had invested heavily in these securities. The crisis soon spread from the housing market to the financial sector as a whole. In September 2008, the investment bank Lehman Brothers filed for bankruptcy, which sent shockwaves through the global financial system. The bankruptcy of Lehman Brothers was a major turning point in the 2008 stock market crash. It was the largest bankruptcy in U.S. history and marked the beginning of the financial crisis. The crisis continued to spread, and many other banks and financial institutions also began to suffer major losses. Governments around the world stepped in to provide financial support to their struggling banks, but the crisis continued to escalate. The stock markets around the world began to plummet, and many investors began to withdraw their money from the markets. The 2008 stock market crash had a profound impact on economies around the world. In many countries, the crisis led to a significant contraction of the economy and a sharp rise in unemployment. Banks and other financial institutions faced huge losses, and many were forced to close or merge with other banks. The 2008 stock market crash also led to a significant increase in government debt. Governments around the world stepped in to provide financial support to their struggling banks, and many countries also implemented stimulus packages in an attempt to revive their economies. In the United States, the 2008 stock market crash had a major impact on the housing market. The number of foreclosures continued to rise, and many homeowners found themselves in negative equity. This meant that their homes were worth less than the amount they owed on their mortgages. The 2008 stock market crash also had a significant impact on the global financial system. The crisis led to a significant increase in regulation and oversight of the financial sector, and many financial institutions have since been required to hold more capital and take on less risk. In conclusion, the 2008 stock market crash was a significant financial crisis that had a profound impact on economies around the world. The roots of the crisis can be traced back to the early 2000s and the boom in the U.S. housing market. The collapse of the housing market and the resulting credit crunch created a wave of losses for banks and other financial institutions, which triggered the financial crisis. The crisis had a significant impact on economies around the world, leading to a contraction of the economy, a sharp rise in unemployment, and an increase in government debt. The 2008 stock market crash also led to a significant increase in regulation and oversight of the financial sector. In the aftermath of the crisis, many countries faced severe economic challenges and struggled to recover. Some of the most common recovery strategies included government bailouts of struggling financial institutions, central bank intervention to stabilize financial markets, and aggressive monetary policy to stimulate economic growth. In the United States, the Troubled Asset Relief Program, TARP, was established to purchase toxic assets from struggling banks and prevent a complete financial meltdown. The Federal Reserve also took a number of measures to stabilize the economy, including reducing interest rates and launching large-scale asset purchases, known as quantitative easing. In Europe, several countries faced severe debt problems and required financial bailouts from the European Union, (EU), and the International Monetary Fund, (IMF). The EU also established the European Financial Stability Facility, EFSF, to provide financial assistance to struggling countries. Despite these efforts, the global economy struggled to fully recover from the crisis, and many countries experienced slow economic growth, high unemployment, and widespread debt problems in the years following the crisis. To prevent another financial crisis from happening in the future, many countries implemented reforms to improve financial regulation and oversight, including the creation of the Financial Stability Oversight Council, FSOC, in the United States and the European Systemic Risk Board, ESRB, in the EU. In conclusion, the 2008 financial crisis was a major turning point in the global economy and had far-reaching consequences for many countries. Despite the challenges and setbacks, many countries were able to recover and grow, and a number of reforms were implemented to improve financial regulation and prevent future crises from occurring. This is how world got affected by financial crisis in 2008 and recovered. If you liked our content, do like, share and subscribe, and also suggest topics for upcoming our videos.